The 2011 United States debt ceiling crisis was a political standoff over how much the federal government could keep borrowing. The debt ceiling is the legal limit on total federal debt already authorized by Congress. Lawmakers reached a late deal before the Treasury exhausted temporary measures and risked missed payments. The crisis mixed a hard borrowing limit with partisan budget fights and growing fear that the government could miss obligations. The debt ceiling limits borrowing authority, while the budget deficit measures how much yearly spending exceeds revenue. The final law raised the ceiling and paired that move with projected spending cuts spread across future years. One lasting lesson is that payment mechanics can become a market event even when the underlying debate is political. The crisis ended with a higher limit, spending caps, and a credit rating downgrade that widened the debate over fiscal policy.